Good afternoon. Welcome to Fusion Financial and our latest webinar. So today's webinar is going to be about your business and the money that you've got sitting potentially in the bank and how you can get that money working harder for you. And we'll be going into quite a bit of detail on that.
Hi, everybody. Thanks for all joining. So I'm a financial advisor here at Fusion. Do a lot of work with company clients, given the nature of the 360 service that Fusion provides. We get introduced to a lot of corporate clients who, many of you will be today. So, that's the specialism, and that's where the focus will be today.
My name's Neil Jacobs, head of Fusion Financial. I've been, previous to this, running my own practice for over 10 years, working with private individuals and SMEs. And one of the things that Josh and me have found over the years is effectively businesses that had surplus cash and it wasn't really doing anything for them. So we got our heads together a few years ago and put together a service proposition which allowed a number of our clients to have some of that money that there was no need for, to work harder for them, and also money which they needed in the shorter term, try and get better interest on that. So we'll come to that in a moment.
Yeah, good. So, the webinar today, the agenda is, identifying the problem, right? Which Neil mentioned, could be the fact that you as a business now has additional surplus funds within the business, which, from a business operating point of view, is no longer required for the day-to-day running, right? That creates a problem as to, what do you do with these funds? Do you try and draw them out via dividends and salary, or do you leave them in the business and utilize them to their full effect within that structure? We'll look at the cost of doing nothing, right? Because what we found over the years is many, small and medium businesses just don't have the time to focus on the additional cash, which is building up year after year. And that in itself causes a problem because, especially in the high inflation nature that we work with right now over the last few years, that inflation eats away at those surplus funds. We look at kind of why this keeps happening, why you don't have the time to manage this, why you don't have the know-how to do anything about it. And then look at the solutions in terms of what options are available to you as a small and medium-sized business to either increase the interest rate you get on your surplus cash or look to do something a little bit more interesting and adventurous than just leaving everything in cash for the funds, which are very strictly for the long term, right? Anything with a longer time horizon, should it be sat in cash? Maybe, maybe not, but we'll discuss that as this goes on. The three-tier structure that Neil spoke about a minute ago, which we put together, we'll go into some detail there. And then the practicalities and how this works in reality in terms of solving the problem that we identify. So what is the problem? Well, one of the problems that small and medium-sized companies have is every year, they're operating at a high level. They've got money coming in, and that money that's coming in is, very simply doing more than it needs to in terms of paying the day-to-day operations of the business, right? That creates this surplus funds, and over time, those surplus funds can grow at a rate which really, can become fairly considerable. But because you're not necessarily investment minded or investment savvy, you just are very much focused on running the day-to-day operations of the business. This problem becomes something which isn't even thought about from a company operating point of view, right? That can result in leaving the cash that gets built up in the current account, which ultimately may not be receiving the highest rate of interest that you could be getting elsewhere, right? That's the first problem. And the other problem to that is after a certain level, if you're leaving the cash that you've got in the current account, well, there's only, £120,000 worth of protection should anything happen to that bank, right? So, you'll see the numbers here that we kind of identified all those years ago, right? And the average return on a corporate deposit account is somewhere around 1%, right? Now, when you consider the Bank of England base rate is running at 3.75%, why are you settling for a lower rate than what that 3.75% figure is offering, right? Beyond that, you can see that 3% UK inflation rate figure, which, it goes up and down, but it's been, higher than what the Bank of England targets for a number of years now. If you're receiving an interest lower than that inflation rate, the real term value of your funds held in the business is reducing over time. So that is causing a problem, which over sort of the 1, 3, 5 years will grow and grow and start to work against you holding cash in the business rather than working for you, where this cash within the business could be growing at a higher rate than the inflation rate.
So in reality, and we just used an example of a company that had 2.5 million surplus. Now, it's all relative. If you had that money on the example Josh was talking about there, the business is only going to be bringing in terms of interest, about £6,000. So effectively, that money is going to have less power for the business over time. It's going to lose its value with inflation, and that will impact how efficient that money could potentially get used for the business in the future. If you optimize that cash because you did want to still keep it fairly liquid, then the interest you could get on a better rate is quite considerable at 99,000. So there's a massive difference. In reality, there are ways where you just need to break things down. But at this part of the webinar, we are talking about liquidity and keeping your money in cash. So we're looking at potentially easy access for some of it. Potentially some of it would go into a time-weighted account where you may tie up some of it for 30 days or 3 months. And there's many options available, including the money market. But the reality is just putting a bit of time into this can make a significant difference in regards to getting some passive return into your business, rather than just moving it to your standard deposit account linked to your business account, which is not helping your business out either. So it's really important to consider, what am I getting from the bank, and can I be doing better for the easy access cash deposit side of things?
Yeah, and there's really, four main reasons that we've kind of identified as to why, surplus cash stays idle, untouched in the business, right? And one of those, the first one is very simply, admin friction, right? Opening multiple accounts to try and find that best rate is time consuming, and you may not, even know where to turn to try and find and identify those higher rates, right? Which leads to, as a business, you decide, let's leave things in our current account, regardless of whatever interest rate we are achieving on that, because you don't have the time or the know-how to go through that admin process of opening up these new accounts that pay a higher level of interest. As I said, this is time consuming, and cash where it is compared with cash at a higher rate, if that takes up a lot of your time to try and find those higher rates, is the payout worth the time that you spent trying to find those rates? Well, yes, ultimately it will be, but just trying to figure out where to start is the first solution to that problem. And I think the other one that we really identified as being that key breaker, especially for companies with higher levels of turnover, is the FSCS protection side, right? So any bank account that you have will be protected from the Financial Services Compensation Scheme up to £120,000, right? Anything beyond that is at risk. Now, the risk as is defined as very low, because we find it unlikely that the banks would go under and you'd lose your money, but it is a considerable risk if your funds are over that £120,000, right? It's one of those which is, what if this happens, and are there other options for me to look at which may be quick fixes to resolving that potential problem, right? The other thing is, and this is very much psychologically based, and it's that false comfort of having a large amount of cash in your current account as a business, right? It may seem like the right thing to do. It may provide you with that comfort that, whatever happens in the business, whether you have good months or bad months, you've got this large cash reserve to draw on in the times when you need to access that cash. But the reality is especially in kind of high performing businesses or businesses which have a consistent turnover, is that comfort net of the large bank balance increases year on year, right? So what happens is every year that's increasing, your comfort level is going up, and all you've really done is missed out on an opportunity to access a higher rate than because you left the money in those accounts. So I think those are the four main reasons. It's easy to identify the reasons as to why that may apply to you. What's harder is changing the mindset from having everything in your business current account into something where the returns are greater and you're creating this passive level of income for the business just on idle funds.
And one of the things, Josh, you would do, and myself, is we can work with their accountant who knows about their inflows and outflows, and we can do some modeling. So effectively, we work out what is the comfort zone of what you should be keeping directly linked to your current account. And then we can kind of build it out from there. But there's some other complementary routes that can match up really well with the need for cash. And that would be corporate treasury, which is effectively using a platform, moving money away from your deposit accounts and effectively using the money market. Generally speaking, it's more competitive. You get a slightly higher rate than your deposit accounts. The downside of it is obviously it's moved away from your banking and onto a platform, but essentially you can still get access to that money within a number of days. Another really useful facility is, and there's more than one provider, is Flagstone. And that is essentially a portal that has all the different banks available on it. So you log into one place and you see all the best rates, and that can help you obviously spread your money across different banks. So you have that protection of the 120, and it allows you to manage your money more efficiently across different providers, getting the best rates. But the one thing that Josh and myself have found with Flagstone, certainly if you are fortunate enough to have really built up sufficient funds behind the scenes in your business, is you may run out of providers to use. And if that's the case, then corporate treasury service can kick in as well, where we use the money market and we can use numerous money market funds. So you can get 4.5% on that. All of these options here are still very much easy access, short term, but vastly different to that 1-2% you may get from your business banking service. So essentially, it's just worth putting that time in to do this, because to be getting 10K a year and then changing things around to get potentially 99,000 if you were fortunate to have 2-point-something million, that's a few salaries in the business. So, it's put the time in, get that extra interest, and just get that money keeping up with inflation.
Yep. Yeah, and so like Neil said, kind of, the Flagstone is the name, right? The functionality is the fact that it's a cash management platform, right? So there's one or two different providers that operate in this way and give you this level of service. But the reality is, what they're opening you up to is a single platform where you can access multiple banks and bank rates on the same platform, right? So that saves the whole process of going to different banks, opening up accounts with different banks, going through their due diligence and their KYC to get those accounts opened, right? You only have to do that once and your account with Flagstone is open, and you've got all of this access to the different providers that they work with. Now, because Flagstone is a cash management platform and they can pool the majority of their clients' funds, they often get a higher rate compared with if you went to the bank yourself. So just by being able to use Flagstone, you're able to access potentially higher rates than you would if you went direct to the bank as well. Important thing to mention that £120,000 of FSCS protection, that has gone up in April, right? So it used to be 85,000. That's gone up to 120,000. So, the regulators are aware that, the 85,000 was a little bit out of date. It hadn't changed for a long time. So they brought that level up. But for businesses and, high turnover businesses, that's still not a huge amount of protection. So Flagstone allows you access to multiple accounts. Each account that you have, assuming that the bank network is different to the next, has its own £120,000 of FSCS protection. And on that platform, it kind of will tell you exactly what banks are protected and when you've breached that protection of £120,000 each, right? So from a cash point of view, switching from your current account to a Flagstone account is going to be something which benefits you from the off, right? Because the access is very, very much 1-2 day instant access. And you're just switching from whatever rate your current account is providing you, which is likely to be lower than the best rates accessible on Flagstone. And, all it costs is that one single application process and then a bit of time allocating the funds to each account. From the point of view which says, Flagstone has rates which will be variable, the instant access rates will change on a daily basis, and the fixed term rates may be lower with expectations that interest rates come down over time. There is that alternative solution, which is, again, what me and Neil discussed 2 or 3 years ago, which was to have, all of the availability of funds under the same house. So you've got your cash account, your investment account, and your longer term investment account in the same platform. And that is kind of the money market route, which Neil will talk about now. This is an alternative to the Flagstone account. Both have their merits, and both are, viable solutions to the problem that we've identified.
So when we talk about the money market, we're talking about not exactly a deposit account. It's a fund that we place your money in that effectively places the money within the money market, which is a lending facility for banking to provide to the other companies. It's essentially still very low risk, but it's still a slight risk level above cash. So it is a daily trading. It's effectively used by all banks with the money that we put into our own personal banks and our business accounts. But this gives you, the company, the benefit of being able to use it for your own business benefit and get a slightly higher rate. So effectively, it's the way the banks lend money out to other companies on the daily trading of the money market. And the rate within these funds can range from about 4.5%. It does fluctuate, but it's essentially very low risk. And all of these, the Flagstone and the money market essentially is cash. So they're not investments. So it's a really useful add-on or essentially a complete alternative to using Flagstone, and will allow you to get the most competitive rate out there. Josh and myself have numerous clients that are using the money market, but we also have a few clients that use both. So it's not use one or the other. It's understanding how they both work, seeing whether there's a favored route for you as the client. If it is to earn more interest and we can get that through the money market, then that can essentially work. Or if you need literally a couple of days turnaround for access, then essentially the Flagstone alternative may be better. But within the money market, you still get access to that money within a number of days. So it's still very liquid. If a client asked me today for the money, essentially that money would be readily available as cash again within 3 to 4 days, and then we'll get that money paid out. But with both of these solutions, you kind of build it out. So we'd have money on Flagstone, would have money in the money market, but you'd also have money essentially kept within your bank that you need for a number of weeks or months. So you've got money readily available. And look, none of this stuff we've spoken about, and I think Josh be the first one to admit it, is exciting. But we understand how businesses work, and we understand that liquidity and knowing that you've got X amount available to keep the lights on if we have a negative turnaround in the business cycle is paramount. And essentially, once we know we have that amount available, then we start looking at a more bespoke service that we offer, where we break things down for short term, Flagstone, and the money market, and then medium term, which can be used for the long term as well. And that is where we look at income. So it's a really interesting area to focus on, and essentially also very tax efficient for your business. If your business has funds available that you do not feel you have any need for, but you also don't want to take out of your business, then it's really frustrating seeing it sit within your business, losing value. And while you're working really hard on growing your business, on building it out, seeing this money essentially sitting there. Now, some of this money may be used to reinvest in the company. That's fine. But anything outside of that, then essentially you can invest that money for income. And because the way we do our investments, it's counted as franked income, there would be no corporation tax to pay on that income. And the reason being is the government see that if a dividend's being paid into that investment that we've put into place for you, then the company that's paid out that dividend has essentially already paid corporation tax on that. So they're not going to double tax you. So on these funds, if they are UK based, they see it as an allowance where if we invest your money and we set up an account for the medium term or long term, we're producing dividends, no corporation tax. So that's dividends getting paid out of the investment into your business. And on top of that, not only are you getting the dividends, your account is also growing based on the value of the companies we've invested in. So you get distribution of dividends plus growth. Now, any growth you make on realization of that growth, on that basis, you will pay corporation tax. But on any distribution of dividends, no corporation tax. And if you were essentially looking to take some of that money out of the business for your own benefit, then at that point, you'd pay income tax at your own marginal rate. So really tax efficient. In terms of dividends, it's really dependent on your risk level. It could range from 3.5% all the way up to 10%. And as we all know, it can fluctuate over time due to the businesses we've invested in, geographical changes in the environment or political movements. But we find that the medium-term investment, which is franked income, has not only provided good dividends for our clients, it's also grown really well for them. Long-term investments is essentially looking for growth. So we're investing in funds that are looking to grow. They're over time, we're looking 5 years plus, and this is money you have no plans for it in that period. And while that money is invested, there's no potential tax to pay until we realize the gain. And essentially we can diversify, we can spread, we can make it international. But when we look at a client, we plan out, what do you need short term? What do you think you may need medium term? And then we can also plan out the long term. And for some clients, that long-term growth strategy, we can also incorporate some of that medium-term franked dividends into it at a lower rate, because effectively it's investing in companies looking to grow, whereas they may not be so focused on paying out dividends. Some are still getting paid out, so we may as well incorporate some of that distribution into that, so you benefit from that tax-free dividends within the long-term strategy as well. Now, when we look at these three pillars, every company is different, and we also don't know what's down the road. So essentially, even though you've put money into the medium or long term, if suddenly there's been a change in your market, or you suddenly had an opportunity that's come by, we can still get access to that money.
Yeah, and I think kind of not to reiterate the point on, the difference of different accounts, but I think where as a business it's worth identifying your kind of cash flow forecast is what do you need for the next 6-12 months, right? And I mean, what by that I mean anything beyond the day-to-day running of the business, right? Anything that's coming in the next 6 or 12 months, which could be a large business expense, right? Because it's then that money which will be best placed in either the flagstone or the money market account, right? The current account, should very much be used for the day-to-day running and a little bit of an emergency fund should you, not receive invoices or not get paid from some of the work that you do. Beyond that, looking into the money market funds and the allocations there is something which we can work with you to identify. And then it's a case of beyond that, as a business, 3, 4, 5 years, what money do you have that you don't need in the business that you can use to tie up in some of these investment accounts? And the truth is, these accounts, they aren't completely illiquid, right? It's not as if you're putting the money in and you can't access the money. You still have the same liquidity rights as you would in the money market fund. The only difference is, because these are investment accounts, there's a level of volatility that we're going to see over 1 year, over 3 years, over 5 years. And over the shorter period of time, we can't guarantee that you'll get back exactly what you put in if you need to access the money at a short period of time after investing, right? So we want to make sure that it's absolutely for the medium and long term, right? And if it is, then we're fairly confident that the dividends that we'll be paying into the company as an additional income stream are going to be a great way to add that income source. And then the underlying investments from those investments is a great way to grow and do the heavy lifting on the cash that you previously held in the current account, right? So these example figures are very much illustrative, and as we kind of get to know our clients better, we understand what their objectives are, what their time horizons are, and what they're really looking to achieve with their business. But the short term, we're looking at anything from 4 to 4.5% on the money that you hold, either with Flagstone or in the money market funds, right? That will change as the Bank of England increases or decreases the interest rates. But it's been fairly set at the same level for a while now. There's that expectation that there's probably another increase to come, right? If that increase happens, what will happen to the money market or the Flagstone accounts is those rates will also increase at a similar level. Then beyond that, the medium term dividend income portfolio that Neil spoke about, there's two levels of the way that you will receive your returns. There's that dividend payments into the business, which can either be paid to you as an additional income source or reinvested in the underlying investments. And then there's the capital growth on the underlying share prices. Now, the dividends, those are not guaranteed at a certain level, but they will be paid every quarter or every 6 monthly period. And that will come in to the business each time that those dividends are paid out. And the capital growth is where we're going to see that level of volatility. And that's why we need to make sure that we've got the time to invest, rather than thinking, in 6 months, I might need that money, so we'll take it from the invested account. That's not something we want to be doing, because we don't want that short-term time horizon to take money out at the lower level. Connor?
Yeah, I was just going to say, we're talking about dividends here, and obviously that would come from stocks and shares. But in reality, these two options that Josh and myself have been speaking about, we can, like if you were a private investor, look at your risk tolerance and your attitude. So you don't need to be adventurous to benefit from these two approaches. You could come to us and say, I'd sooner take a more moderate approach, not 100% be involved in that equity market, and you can still benefit fully from this strategy. We would just invest 60% of those funds that you had available into equities, and then look at less volatile investments such as fixed interest, which would be gilts, corporate bonds for that other part. But that investment will still totally benefit from everything we spoke about.
Yeah, and then the same principle applies really with that long-term growth account. It all comes down to what is your attitude to risk, right? And we're not looking to take any extra risk than you as the business or you as the client is comfortable with. We're looking to develop a bespoke portfolio which takes your risk and your time horizons into account, so that we can look to achieve exactly what we set out to do in the beginning, right? If you come to us and you say, look, I've got all this money that is sat in the current account, but I don't want to leave it there because of the principles you mentioned, but I also don't want to take too much risk and invest it all in the market. Well, we'll come up with a portfolio which is either lower risk or a balanced risk, to make sure that you're not missing out on the opportunities that you have because you've built up this excess cash balance, but you're not overly risked in terms of where your position in the markets are, right? So that's where kind of the deeper discussion, as you become a client, as we get to know you, and as we sort of learn about your business and your circumstances, comes, because that's when we can become a partner to your business from a cash management point of view, compared with leaving you to your own devices, trying to find those best rates and trying to maximize the potential of the reserve cash that you've got in the bank account.
So, Josh, I don't know if you found this, but I've got 2 clients, I think, over the last couple of years that we set things up in this way. They did use the 3 pillars. However, over the last couple of years, that cash element has shrunk because they decided that there was less of a need. It was more for comfort. And as they felt more informed and got used to our approach to managing their money, I saw quite a lot of that money move into the medium and long term. Essentially, for both of these clients, they preferred the dividend one, so we essentially increased that account, and their cash reserve account shrunk. So just because we set things out at the beginning, our responsibility is to keep informed with how your business is going, what you guys are wanting to achieve, and this can evolve over time. You also get full visibility as well. So this isn't you giving up full control. Anything we do for our clients, you'll be able to log in, have that visibility, see what's going on, and also have Josh's number available. So if you want to have that chat, we're basically on the hotline, ready to assist you as and when required.
Yeah, and that flexibility is really important. It almost works in a way where you funnel money from the current account into either the Flagstone account or the money market account, and then as you become more comfortable, as your cash balances continue to build up, and you've got higher levels of reserve, that funnels into the medium and the longer term portfolios, right? So it's all about being flexible, and it may be that it needs at some point to go the other way, and you need to take money from the longer term account or the medium term account and put that into the current account because the business is short of cash. And like I said before, the funds aren't tied up, and that there is always that availability of access in those circumstances where you need to go the other way and generate some cash. I mean, I know, Neil, you've worked with some businesses which also do kind of property investments through the business, right? And they but property and identifying those properties takes time to purchase. So while they've got that cash available, they use this service to have their money this outlined and designed for property purchases in the short-term account in the interim period while they're waiting to purchase the property.
Right? Yeah, I've also got charities where they've had funding from a donor, and they've got one of the charities was given 5 years of funding. Now they can't just be sitting there having that money earning 1%, because when it comes to year 5 to use that reserve, they're in trouble. It's lost the power that the donor wanted it to have. So every business has its own requirements and needs, and it's for you to Josh, the advisor, and myself to really get to know what they are and then kind of build the plan around it. I'm going to move on, Josh, to the next bit, if that's all right. Is there anything else?
No, all good.
All right. So, look, I'm here and Josh is here to understand you as the client and your business. You know, where is your position? And then essentially build out that plan and give you an idea of what those numbers can look like. And then we can turn this around within a number of weeks. We're here available for informal conversation if you want to learn more. It's not a problem. We both love working with businesses because we get to see all these different kind of industries and professions and get a bit more insight. So feel free to pick up the phone, use the link above, book some time in with us. We're here to assist. And then in regards to the questions, I've seen a couple. I'm going to jump on a couple now, Josh.
Yeah.
I've got one here about first of all, it's about if you were going to benefit from BPR, how would this affect things? Now, in regards to the flagstone, like it is cash. And effectively, the money market isn't really seen as an investment. So you're all right in that sense. When you start looking at the medium and long term, then essentially we would sit down with your accountant or your tax advisor or our tax advisors within Fusion and work out what is the magic number that doesn't essentially turn your business into what the tax man would see as an investment house.
Yeah, another couple of questions. I think some of them were answered kind of within. Miles, you had a question about Flagstone. You said you use it day to day. Is the protection level now up to 120k? Yeah, that's right. You know, it used to be 85,000, was set at that for a long time, and then that changed in April last year. So that is now £120,000 per account. Taryn, you got a kind of follow-up question to that, which is, you know, the protection level is per deposit account. Is that correct? Yes, that's right. So if you have 3 different banks, all, you know, and none of them are part of the same group, because there are banking groups that, you know, do have multiple banks within the same group. For example, Lloyd's, who have sort of Halifax and others. As long as the banking group is different, you get the protection on each of the different accounts. And that's where Flagstone really comes into its own, because it will tell you, you know, what the links are between the different banks, how much you've got in each different bank, and you know, when you reach that protection limit, it will tell you, you know, are you sure you want to add more money to this account rather than finding another one. So that's that. I think just read one here, Jonathan. I assume one pays corporation tax at year end on any interest earned, as opposed to the tax-free dividends you alluded to. Yeah, correct. So any kind of interest income that comes from the cash holdings or the money market funds, yeah, that is taxed as corporation tax rates. And I think it's another reason why having that tax-free dividend income is just another great opportunity, because you're not taxed in the same way, right? So even if you're receiving, you know, the best possible case at 4% on the interest income, you know, after tax, that's dropped to 3%. So when you compare that even to a lower risk dividend based portfolio, which is going to produce 3.5%, that's coming in net rather than gross. So you know, that's an important point going
there. Just to build on what, if a client's taking a moderate approach and they're getting 3.5%, doesn't sound very exciting, but they've also got to bear in mind that their account may have grown by, certainly this year, double digits in terms of growth, because of obviously the companies you invested in are not only able to pay out the dividends due because they've had a good year, the value of those businesses has also gone up in value. So even though you are a moderate approach to risk, and that's what we set up, and it may only pay 3-4% in dividends, that doesn't mean that the actual growth within your portfolio from the value hasn't grown by double or 3 times that. And that's not how this year we've seen it.
Yeah. Barry, kind of, yeah, what is your cut? Is that a percentage or based on results? So, very difficult to answer that question on a broad kind of basis, but it will all depend on, what options we're looking at to provide you with, whether that's the money market fund, whether that's access to Flagstone, whether that's, the short and medium term and longer term investment portfolios, and also kind of depending on, the level of investment that you're looking to make. So, that can be discussed if you've got, or if you book a meeting with us, we can talk about fees. But I think this is less about fees and just opening up your minds to, what options you have as a business, which you may not have considered to this point.
Yeah, I mean, look, essentially, we wanted to educate some of you if you didn't know about this already. I'm sure some of you knew some of this. And at the same time, you've got the link above to book into our diaries. There's no pressure here. If you've got some questions, feel free to book some time into our diary. There's no obligation. We're both friendly chaps who are happy to give away most of the time. And we're happy to, give you the information and advice you require and hopefully potentially do some business together. Thank you for your time.
Thanks, everyone. Cheers.